and welcome you all to yet another exciting fund manager interview with PMS Bazaar. I am your host Arvind Ravindran, and today we are privileged to have with us Mr. Mahesh Gowande, Director and Chief Investment Officer of PriceBridge. Mr. Mahesh is an equity futurologist with over 2 decades of experience navigating capital markets. His journey has been shaped by relentless pursuit to understand the deeper patterns influencing market behavior. At the core of his expertise lies a unique blend of behavioral analysis, time cycle forecasting, and a commitment to capital safety. Welcome, sir. And it's wonderful to have you here with us today.
Thank you so much. Thank you, PMS Bazaar, for inviting me. Thank you so much.
Yes. To begin with, could you tell us a bit about your journey, sir? What led you to start PriceBridge, and how has your experience shaped your investment philosophy?
So, after completing my BCom and then doing my master's in economics, I was always keen towards stock market and investing as a word. And during that process, when I started studying about human behavior, behavior economics was one of my key subjects for me to learn economics. During that time, I realized then the 1987 crash happened. That time it really got me attracted because there were few Indians in the global market who actually could predict that, and they actually adjusted their portfolios based on their own predictions or whatever forecast, whatever you say about that. And that really attracted me to something like this can be really done on a very big scale. So that was the starting point of why I came towards stock market, or why, because my family background, we are into construction line or contract line, electrical instrumentation. So typically as a normal family business, I would have been there, which I did for 10-15 years. And then eventually I moved to stock market. I started studying this behavior analysis, why people get excited and all this stuff. Having an economics background, having a BCom background already, and since managing own business. So balance sheet reading, fundamentals was part of it because I was doing my own family business balance sheet. So that was there. What really attracted me to growth trajectory, what India was actually going through. And that is where I started looking at Indian markets as a big thing. And then initially I started as a consulting, advising, and then eventually I realized it's not so easy. There is one more thing apart from research. There is an execution platform or execution skill that is needed by the investor after executing. There is one more thing of managing those investments. So there are 3 legs to investment. One is knowing what to buy, second when to buy, and how to manage. And that is where actually I started this price bridge. So price and bridging the concept between the time and time cycle. How do you manage your investments? I'll give you one example. Just like in a garden or just in this thing, you have to cut the tree for further growth. There's trimming is required. So similarly in the portfolio also there is some element of trimming is required, some element of adjustments is required. That will generate the alpha. You don't have to change the stocks. Maybe the same stock which is you're holding for 20 years, even if you do small tweaking in that journey, the alpha can be 2 to 3% more for a 20 years. And that 2-3% will actually change the returns of that stock profile. And that is where actually I started looking at managing the portfolios. So that's how I started the PriceBridge. The PriceBridge name is between time cycle and pricing. So that's the thing. Tell me.
Wonderful, sir. It's clear how your experience has shaped how PriceBridge approach portfolio construction and risk management, sir. Mahesh, sir, compounding requires patience, but investors often get restless when markets move sideways or volatile. So how do you think timing, delayed execution and discipline helping in overcoming these psychological barriers?
So typically as the SEBI always gives or comes out with and releases the data that 92% people lose money, practically 97% people lose money, or all this data, what really indicates is people get excited, people get carried away in this thing. And that is where you have to be away from the crowd. Now, how do you know whether I'm in the crowd or I'm not away from the crowd? There's no way you can actually identify yourself, what is my situation, where I am actually in. So, the how to overcome it's very difficult because humans, even after knowing, as I said, knowing and executing, we are not trained to execute things. We can plan, we can visualize, but execution needs patience and practice. More than patience, ultimately, execution needs constant practice, the hammering, which we don't do. Most people actually lose patience and then they stop doing the same thing because, uh, first thing, there's lack of knowledge. To be very honest, first thing, there is lack of knowledge. There is no proper understanding, or uh, in school we are not how to manage money. For that matter, even global markets, there's less understanding how to manage money, and from there it starts everything. And if there is no discipline, then it becomes very difficult to inculcate those qualities in you. So unless it is trained at the school level or university level, how to manage your funds, it is very difficult. So somehow, since we studied, we have put that everything on a technological platform. So which we have built as a technology platform where execution, risk management is managed there. So there are parameters which we do, and that is how we actually do. As far as investors can just, instead of getting carried away with the news or instantly reacting, they can just delay by waiting for maybe 10 days or 5 days. Because I always tell this to people, market gives you 3 times, 4 times opportunity. Market is there because of you, and market will always give you opportunities again and again. So if you think the FOMO gives more losses. That is the universal truth, and still people get into same mode. So once you understand, once you accept that market will give me one more opportunity to enter the same stock, you will not lose money. I'll give you one small example. People always talk about stop loss getting triggered and then the price goes up. And I always ask people, why don't you enter after your stop loss gets triggered? Understand what I'm asking?
Yes.
If you know that after triggering the stop loss, the price goes up,
Yes.
then wait for the stop loss to get triggered and then enter the price.
Yes.
Right?
Correct.
This simple action can actually save 50% of the losses. This is one simple action.
Got it.
That's it.
It's clear how long-term success in investing ties back to behavioral discipline rather than
Yes.
pure strategy, sir.
Yes.
You have built PriceBridge around the idea of generating returns while keeping fees and volatility low. Quite a distinct proposition in the PMS space. So, what drove this philosophy, and how do your proprietary system translate this vision into real portfolio outcomes, sir?
Okay, so generally it is widely accepted that higher risk means higher returns.
Yes.
And somewhere I felt that is not the truth. I mean, you don't have to take higher risk to take or earn more returns. There are ways where you can actually take similar risk and still make good money.
Yes.
And that was the first thought that came into my mind. Is it really I have to take extra risk to make that extra earning? I felt no. We can do it better by using it properly or by using time cycle. You can delay your actions and you can improve your returns. So while most of the fund managers or globally it is norm, never try to time the market. But I always believed, yes, you should not try to time the market, but you should try to time your actions. That was one major thought that actually triggered, and I did a lot of data analysis, research on that, and then I realized, yes, if you time your actions, forget the market, what market is doing or what overall general macro economic numbers are saying. But if you time your actions, you can earn similar returns without taking additional risk.
Yeah.
So that is very much possible. See, if I say Nifty is giving me 12% return for last 10 years, it is not giving you in a linear way, right? So out of 12 months, it would be only 4 or 5 or 6 months where the actual momentum comes or the real money comes.
Yes.
So if you can just, you don't have to be very perfect about your timing. You can have a range. If Nifty is doing between this 5 months, take 8 months, take 9 months. You have to just extend your range and just ensure that you are avoiding only 2 or 3 months from the year. How do I explain? So if a stock is giving you 15% return,
Okay.
it will be only 3 months or 2 months which you have to just wait, delay your action and participate.
Yes.
And my simple observation, most of the people use these momentum indicators or the so-called 5-year breakout, 3-year breakout, 1-year breakout, and then the price will become 20% more. What I realize, when this breakout comes, after 2 months, 3 months, the price again comes down, or what we call as a correction or retracement. You, instead of buying at the breakout or chasing that breakout, wait for 3 months, the price comes down, that time you buy. If it is going to give you 20% return, you will earn 18% return. But you are reducing the time frame. Instead of getting invested for 13 months, you are getting invested only for 10 months. So your CAGR is actually improving. You're getting what I'm saying?
Yeah.
Your CAGR is actually improving.
Yes.
You're not invested for 13 months. You're invested only for 10 months.
10 months.
So that's okay.
Yeah.
That's how compounding will ultimately happen.
Correct. Yeah, wonderful, sir. Especially how your process blends a quantitative rigor with behavioral discipline.
Yes, it's more about behavior and how you follow. So I'll add one more thing. So a trend following system, when we talk about trend following system, if a trend is uptrend, it will have more corrections.
Yes.
Because there will be constant profit booking by the swing traders. So uptrend stock will give you more corrections, dips.
Yes.
Because people always fear ki I will. So people tend to, the 99% people who actually don't make money in trading, or 97% people who don't make money in trading, they book profit in a very small gain.
Yes.
They hold losses for a long period,
hoping that
the stock will go up. So typically when the trend is up, majority of the people, they fear that they will lose the gain and they keep selling.
Yes.
And you get more opportunities in an uptrend market to buy during the correction. So if you even just follow that simple approach, you are still saving your time. So a trend following model, most of the traders actually don't make money in trade following model. They actually lose because they buy, they sell. When the correction begins, they sell. So their stop loss gets triggered. They again enter the same script, they again sell. The stop loss gets triggered. The 2% stop loss, the 3% stop loss, people have this vague ideas of keeping 2% stop loss. The moment 2% comes down, they will sell. So from where this they use, I don't know, but during an uptrend, you get more better opportunities.
Yes.
So that is a simple discipline. If you maintain, I'll buy this stock or invest in this stock during a correction. That's it.
It's really interesting, sir, how your process blends quantitative rigor with behavioral discipline. Now, coming to your process, your Honeycomb portfolio designed to fall less during down markets and rise more during up markets. So, tell us how you designed this strategy to achieve this portfolio outcome.
So, Honeycomb portfolio is an ETF portfolio. And what we really do is there are so many sector ETFs, there are so many smart beta ETFs, there are index ETFs. So we actually mix those. We are using some part of smart momentum strategies. We are using plain index in our portfolio. So whenever we have our markets really become expensive, so that time we actually reduce our exposure to momentum indicators or the smart beta portfolios because they are already giving higher returns. So we reduce there. Then by increasing exposure to the sectors which are cost effective or what you can say as fair value price, we slightly increase the sector exposure because already they are undervalued or they are fairly valued. So the fall in those stocks is less or limited. See, when the trend is down, everything comes down.
Yes.
But some things which are already undervalued will decline little less, and things which are over expensive or where, very honestly, where people make money, they may book the profits there. Where people have not made money or things which are already in loss, people don't book the losses.
Yes.
People prefer to book the losses, profits first.
Yes.
So wherever the prices are high, people will start selling those things.
Yes.
And it happens with all of us. And because of that, what we generally try to do, we ensure wherever there is a fair value or fairly valued a sector, we try to increase our exposure to those ETFs. Like pharma, not necessarily that FMCG would be a fairly valued, because FMCG stocks are actually very expensive.
Yes.
Their multiples are very so. But then nobody really wants to sell those stocks.
Yes.
So though they are expensive, people use them as a defensive stocks.
Perceived value.
Obviously, in last 2-3 years, at times even the defense strategies,
Yes.
or what we call as FMCG, they have actually fallen sometimes more.
Yes.
So this time we actually even used gold and silver
Okay.
in our portfolio. So though it's an ETF,
Yes.
so I actually increased my exposure to silver and gold.
Got it.
Though we bought little of gold, just 2-3%, but silver we had more than 10%. So at one point of time, my exposure to silver ETF for last 1.5 years was like 14%. Then we were invested in Hang Seng. So that was China market, which actually did not recover from the COVID era. When the markets fall during the COVID, China was the only market where there was no recovery.
Yes.
And actually they were doing good. Because in last 2-3 years,
Yeah.
China was doing good, though there is issue with US and global market conditions. Still the companies were doing, the market was growing, and somewhere there was value. And since we are tracking the markets differently, so we could actually take those exposures. And we invested in Nippon Hang Seng. So that was almost, in some accounts it was 5%. So in about 20-25%, we actually made good money. Even Nippon Hang Seng has given us almost 50% return.
Super.
And because of that, actually we went down less. When I booked silver, recently I booked silver around during the frenzy times, I reduced some exposure to, actually I have bought it out down by 40%. I shifted that money to metal.
Oh.
And last 1 month, metals have done well. So we do this small switches. We are not traders, but we take strategic calls. Okay, this sector is going to do next 2 years very good. So we slowly accumulate. We don't go and buy at one go. We slowly do, maybe one can even say STP kind of a approach.
Okay.
So we actually try to buy those. So we are also invested in PSU Bank. So we have exposure to Bank Nifty, we have exposure to a financial ETF, and we are already taking extra exposure to PSU. So that is our composition. So obviously when the markets came down, we fell less because we were exposed to these sectors. And that's why today our alpha is also good.
Yeah, wonderful, sir. Sir, for an investor coming into Honeycomb today, what would you say is the ideal holding period to truly see the benefits of this approach?
I would actually suggest, nowadays the medium term is and short term, the definitions have changed, but ideally it would be like 2 to 3 years should be the minimum period. I would actually say 3 years.
Fantastic, sir. Yeah.
Minimum 3 years.
So we know maintaining lower beta than the benchmark while generating stronger alpha is rare. So how does PriceBridge achieve these things through asset allocation levers, or else any structural choices do you follow, sir?
So sector allocation is one part of it. While there are some high, so actually one of the interesting data when we think about compounding, many of the low beta stocks have given wonderful returns in the long term. So we never believed, as I always mention, we never believed in high risk, high return. So you can take a moderate risk and still have a better returns by timing. by investing at the right time. You are not timing the market, you are timing your actions, when to invest in one particular stock. And for that, we have quantitative models, we have proper behavioral pattern recognition models, which actually gives those insight. And because of that, so even in a very high beta counter, if my entry point is very, very good, I mean, if it is at corrective level or it is very bottom out level, then the beta will actually come down because I'm not using very high beta counters. So not necessary that you have to have a very high beta counters to outperform the market. So at times our beta is very low compared to market this thing, and still we outperform the markets. So that is about behavior pattern recognition. And more to do with timing.
Yeah.
Timing plays a very important role, especially when you want to have this strategy, low beta and better returns.
That's a sharp insight, sir. And the takeaway is timing our actions rather than just following the market.
Trend following at times becomes, it's very easy to understand or feel that trend following is a very good model. But being with the trend and at the same time not being with the crowd.
Yeah.
Because if the trend is uptrend, and when you're talking about 90% people losing money, so in that trend only 10% people making money or not losing money, but real money is made only by 1 or 2% people.
Yes.
So from that trend only 2% people are going to make money. So how to be part of that 2% becomes the key.
Yes.
So think like an operator, think like a seasoned player. They are not active every day.
Yeah.
You have to be very specific, you have to be very calculative. When I have to take the action, it does not matter whether I buy it at this price or that price. If your timing is correct, you get the returns.
Yeah. Investors need to disconnect with the herd mentality.
Yes. First thing is disconnect from the FOMO.
Yes.
The herd mentality. That gives you all this thing.
Sure. Wonderful, sir.
And I always believed one more thing. After investing, you don't have to show the patience.
Okay.
Show the patience before investing. Do all your homework. So when you ask me how can I keep my beta low and still have a better returns, after investing we don't show the patience. Before investing, we do our homework, we do our proper analysis, we take care. Just because I get this news or company management has come out with a very positive, optimistic numbers, this, that, we don't react. We prefer to take action by doing proper homework, do your research, do your quantitative analysis, do your behavior analysis, share ideas internally with the team. Once the team is in picture, they will have their own opinions, have a small discussion, debate. Let it be one more week. But before investing, do all your checks and then invest. That makes major difference. That's why I always tell people, don't show patience after investing. You have to show patience before investing. That's it.
Yeah, like how Mr. Warren Buffett is sitting with billions of dollars of cash waiting for the right time to deploy capital.
Yes.
So PriceBridge approach focuses on uniform risk-reward experience throughout the investor's journey. So tell us, how do you ensure this consistency across diverse portfolios like Upswing and Eternal?
When I actually entered the markets, maybe in 1993 or during that time, 1992, that time markets were, BSE Sensex was 2,600 or 2,500, I don't remember now. When it went to 4,500, 4,600, Bombay Stock Exchange I'm talking about. So that time, then the markets crashed from after the Harshad thing, and then the markets crashed. That time there were more bankruptcies, defaults declared by the brokers, individual investors, speculators, gamblers too, always they declare, but even the brokers, there were more. There were defaults from the banks also.
Yes.
So even banks went out of the system. Now, today, Nifty moves 1,000, 2,000 points here and there. Imagine that Bombay Stock Exchange from 2,000 to 4,000, 4,000 to 3,000. Today, Nifty moves 1,000 points here and there. Now think of the risk. If there were people who were losing money in 4,500 BSE index, and today there are less bankruptcies declared.
Yes.
Today brokers don't declare bankruptcy. Why? Because there are good safety margining system now introduced by NSE, BSE, everyone. SEBI has been one of the great contributor to this because SEBI has really done wonders to Indian capital markets. So it's all about how you take risk. We all talk about returns. I'll give you 25%, I'll give 25% return, 10% return, this, that. But nobody discusses about the risk. So when people come, आपने risk कितना दिया है? आपने return कितना दिया है? Nobody asks आपका risk कितना है? आपने return कितना दिया है? Nobody asked me this question. What were your drawdowns? And how much time you took to get out of that drawdown?
Yes.
See, the day you invest, I don't know when the markets will start going down. So the question should be, if you go in drawdown, how much time you will remain in the drawdown? Or what would be the timing? Because there will be a lot of data crunching you can do. So I always believed, if an investor is coming at 10,000, because investor comes because he has money at that time. If somebody comes at 14,000, if I tell him that you should have come at 10,000, he had money today. And why investor is coming to me? Because he doesn't know how to put or invest money. Forget about the return. He's also worried about returns. He's worried about risk. He's not sure about how to take risk, or he's not understanding the risk part. As a fund manager, my job is to be fair with the person who came at 10,000 and also with the person who came as an investor who came at 14,000. If I can keep risk profile same while investing their money, every stock, every company has its own risk profile.
Yes.
How much it can go down or how much it can come up. According to that, if I shift my weight allocation, then I will be able to maintain same risk profile. So when I started my PMS, my first investor, he asked me, will you be able to make money for me at 18,500? I said, I'll answer this question after 1 year, because after 1 year, I don't have to answer. The returns will speak, right?
Yes.
I told him, I will not lose more than 15% for you. That much sure. We went down by some 9% from there. Because when we started, from there till March, we started in 2022 in November. 22 March, 23 March, markets came down by almost 9%. And we were down by 8%. So we fall less.
Yes.
We were down by 1%
Yes.
less. When the markets recovered, even today, he's our first client. Even today, he's 2% ahead of the market. Second time also, during this last March, when the markets this year. So again, he had fallen less than the market.
Understood.
The reason is, if I can keep risk profile, so that is our unique approach.
Yes.
We have models. Again, same thing comes. When I'm saying we do actions for specific clients at particular time, so we are quite specific about that. Why PMS has been introduced? Because sabke liye, if I have to do same thing, then mutual fund is there.
Yes.
Because it's a bespoke industry and we believe that it should be a customized product. The main customization is returns would be according to the client whenever timing is coming or what we are doing. My biggest responsibility is to maintain the risk.
Yes.
Finally, the returns markets give.
Yes.
I am only investing in companies, the company promoters, they are doing all the business and their growth is there. So finally, the returns are given by the market. My job is to allocate funds in such a manner that risk profile is maintained for all the clients at unique level. So it's not that one client is losing 30%, one client is losing only 5%. There will not be ekdam perfect simple this thing, but they will be in the similar range. Like if my one client is losing 8%, the other will be losing 9% or 10%. It won't be like 8% and 20%.
Yes.
You are getting what I'm saying?
Yes.
So our whole point was the investor will even come to that 25,000. And he will come because he has money at that, he is available with that money. As a fund manager, I cannot say don't give me money, but I can deploy those monies in such counters where the downside is very much. Again, one can argue, how do you know the downside? Yes, but there is a way. You use different quantitative model. That's why we have more than 30 stocks in one portfolio. So we don't take exposure more than 5% in one single stock. Though we are PMSs, we are not focused, or we are not in this thing to have 10% exposure or 15% exposure. We believe that 5% exposure should be the max, and we ideally avoid any exposure more than 5%. So we try to control the risk by not taking exposure to one particular sector or even stock.
That's a great explanation, sir. It clearly underlines how risk profiling and underlining companies is very important.
Yes.
Mahesh sir, next we will move to a quick rapid fire round. Each question will have two options. You can just pick the one that resonates your views. Which market segment do you see as offering the best risk reward profile currently?
Mid caps.
When analyzing potential investments, which lens carries more weight in your decision making?
Both the options now you have to.
Quantitative analysis, behavioral analysis.
I go with the behavior analysis.
Okay. For stock selection, which method offers better conviction for you? Top down, bottom up?
I'll say bottom up.
Super, sir. With that, we have come to the end, sir. Thank you so much for gracing in our show. We absolutely enjoyed it.
Thank you so much. Thank you, PMS Bazaar, once again. Thank you so much.
Stay tuned for more such insightful interviews with PMS Bazaar. Until then, take care and goodbye.